Panel discussion. Who's ready? No, fantastic. It's going to be more like a fireside chat. Like, I'm happy to, maybe we'll start there. I'm happy to introduce Christian Vartyan, somebody I've grown to know and love actually over the recent years, and somebody my audience on Soar Financial has grown to love over recent years as well. Just one warning, you cannot smoke on stage. Christian?
Okay, I don't.
You cannot do that. But we really appreciate you being here. You're a portfolio builder over at GIP AG. You have a lot of clients, wealthy clients that you help advise and build their portfolios. And you're a phenomenal technical analyst. Is that the right term, even technical analyst?
Well, first of all, my portfolio is 160 things, so I'm doing a lot of fundamentals too. Otherwise, you couldn't exchange stocks against stocks, right? But yes, besides that, we do a horrible lot of, let's call it technical physics.
Technical physics.
It's more physics than maths.
And we'll get to the gist of everything. Like you brought us a chart we'll talk about in a second. We spoke about 6-7 weeks ago on our YouTube channel. And since then, we've had some macro shocks, I call them, meaning we've had a US election, we had a Fed rate cut and a Fed pause, more or less, because Powell said, oh, we're data dependent, and now the market doesn't expect a cut. Let's start maybe with a quick assessment of the current market environment before we get into some of the specifics and the chart that you've brought us.
Okay. But yet, I would like to use something simple on the chart. And for that, you would have to look at the purple line there. The purple line is the price of the 20-year Treasury. So that would be dollars for real guys, which would want to hold US dollars in a form which is guaranteed by the US Secretary of Finance, of Treasury. So that's the real dollar is that, it's treasuries. Now, why do I answer like that? Because what you want to know is actually gold and silver went down a little bit, but that kind of dollar too. So, did they go down? Yes, but just a little bit. We have to understand the perspective. What we are talking about here, this shock, is nothing else than an abrupt scarcity of money market dollars. And once that abrupt scarcity of money market dollars does not change the relation between real treasury dollars and gold, it doesn't matter. That means that shock was not a dangerous one. If the purple line, at occasion of that shock, would have turned upwards, that would be a sign of prudence for precious metals investors. But fortunately, it didn't.
Because we've seen like maybe the 10-year, like what's maybe we'll start by explaining just a little bit, because I look at the 10-year a lot, the 10-year US Treasury bonds and the yield. And that yield has spiked, meaning the bond prices have crashed.
Yes.
In relationship to the TLT and the 20-year, like how do you see a difference? Like how do you price term risk in, for example, here?
This first you have a term risk price inside of it. I didn't put the 10-year not to create the confusion. If we talk about long-term assets, I put here 3 long-term assets, which would be the Standard & Poor's 500 stock market index, which is weight capped, as you know. So today it's an AI index, basically. Artificial intelligence index. You did see silver and gold. You have 3 prices there. Okay. Now, yes, to answer your question, there is a risk inside of that. But the basic message, and you had it, I think, at your opening of today's conference, you talked about de-dollarization. If you look at the purple line, here it is. Because de-dollarization means the loss of trust in the United States dollar as a reserve currency. Here it is. One has to understand yet, I want to be more specific on your question immediately. One has to understand yet, if you have a monetary system in which money is created solely by increasing credit, then a de-dollarization starts with paying that credit back. Paying credit back means you have to buy the dollar back. You have to buy the spot dollar back while selling the investment dollar. And this is what you see here. You have minus 8.9% of the 20-year Treasury versus the spot dollar year to date until last Sunday. Okay? So there is a de-dollarization, yes, but de-dollarization as a reserve currency means buying back the spot debt currency, and that means the US dollar currency goes up. This is not a problem for any of us as investors, as long as it also goes up against the reserve dollar. So if you would have a gold and silver doing this later on the S&P, of course, because it's always the same, right? And the bonds would go up, that would be a warning sign. But if the bonds go down too, it's not. Okay? Sorry that it's not simpler than that. But this is the truth. There is no other truth. If you want to get rid of your bank, you said you are fed up of your bank. First thing to do is just you have to repay your loans. And that's what's happening. This is why the cash dollar goes up against the investment dollar. And if we look at that chart, our friends, the Standard & Poor's 500, with my beloved NVIDIA share in it, and my beloved Amat in it, and my beloved Walmart in it, and GPM as a bank in it, which I all love and have, did do what this year against silver? Nothing. And against gold? Nothing. Nothing. They stand up the same. So do we have a precious metal upward trend? No. Have a precious metal downward trend? No. Do we have a stock market hype? No. We have silver, gold, and the S&P 500 doing exactly the same to each other this year. You couldn't make any money by exchanging them against each other this year, but you made 37% against the reserve dollar with any of them, or about 27 with any of them against the cash dollar. Sorry, I just wanted to put a relationship, because now I'm ready for all questions.
Now I got a follow-up question on the reserve dollar, because who is repaying their loans? It's definitely not the US government that's paying back any loans, because they could use some more. Who's repaying that? Like, who's buying back the bonds? Like, that's a question. A, who's the seller? Like, I think we can all agree it's probably Eastern countries.
Yeah.
And but who's buying that back, and where is that ending?
Okay, but look, let's imagine you have a government in Southeast Asia. I don't name any name. The government and its institutions did use formerly cheaper US dollar loans to finance plenty of things, which put them into a risk towards the US dollar, and they did counterweight the risk by investing in US investment dollars. So they had those treasuries, but one has to understand, they didn't buy the treasury because they love the USA so much. They had the treasury to hedge their own spot dollar loans. So they were short US dollar, long US treasuries. And now, if they reverse the system, they automatically get the treasury down and the dollar up. Because again, you want to get rid of your bank, the bank says, fine, you don't want me anymore, I'm ugly to you, or whatever, pay back first. That's what's happening. The spot dollar today is being paid back. But it's paying back. It's still a de-dollarization. Leaving your bank means pay back first. Very, very important. People always think that the end of the dollar dominance will start with a decline of the US dollar exchange rate. Wrong. It would start with a decline of the US Treasury price. It's very important.
A lot to digest, but it makes sense. So the question is now, of course, because the US will have to refinance next year. And I think we talked about this in our interview as well back in the days, like term is liquidity crisis. Next year, I think the US will have to refinance 15 trillion US dollars, mostly short-term T-bills that have to be refinanced. If this trend continues, can the US afford it, and do you see the chance of a liquidity crisis?
We have a liquidity crisis worldwide since already 2 years. And whatever author and intelligent people I follow, they just tell you about the worldwide inflation, where all M3 worldwide aggregates point to a worldwide deflation with some scarcity price indices in the West. So the fact is we have the liquidity crunch already, sorry to say that. Look at Chinese stock market indices combined with the yuan to dollar ratio, we'll see that China, if priced in US dollar, is in a kind of a dollar crash recession since more than 2.5 years, and it's the biggest producing economy, okay? So yes, it's a problem. Yet, talking the dollar worldwide, and that's also influencing our prices in gold, in silver, in S&P, in NVIDIA stock, in whatever, is something else than locally. I mean, the US government will find a way to somehow refinance a money which is issued in its own country, right? Okay, the question is at which prices, how they're going to do it, yeah? But when we talk gold and silver, I think that's the issue today, right?
We'll get to that.
We have to go to the global importance of the dollar. And if you look at the Treasury, it's clearly going down.
Talking global importance,
Yeah.
we have a new US president moving into the White House in January, and he wants a weaker dollar. So he has to counter what you just mentioned. Like he doesn't want maybe the foreign entities selling the US dollar or the bonds, right?
Exactly.
And buy back the currency itself. How does he counter that? Do you have an idea?
I have no idea, because after his election happened as a first shot, the opposite of what is his policy. The US dollar spot rate went up. Yeah, we had euro US dollar dropping from 110 to 105. So a president is elected who wants to re-empower US industrial power. What's happening? The opposite of his program, okay? On the next day happened the opposite of his program, which is the correction in gold and silver. So please don't over-exaggerate it. It is a mistake. Okay. So, I mean, if you talk about the Trump program, you wanted a weaker dollar, okay, right? What happened after his election was actually clear. It was a much stronger dollar. For us, I think it's only important if our metals turn south, the Treasury price must turn south too. Otherwise, it's dangerous, okay? So, and hopefully it doesn't. It didn't this time. This is why I'm pretty hopeful that they're going to finance their deficit somehow, okay? But I'm pretty hopeful that this mistake of the dollar jumping up in his forex range because of Trump's election, which, as you correctly point, is a complete misunderstanding because he needs a weaker dollar, right? Yeah. Okay, was a one-day fly. Okay, so far the chart shows it might have been a one-day fly. Yes, it did depress silver from $34 somewhere downwards towards 31, and gold from 27, I don't know, 60, 70, down to 520, which was anyway needed because it's a Fibonacci retracement. So,
I don't get to make it too complicated.
I don't see it as a problem yet, but it was dangerous. Yeah. If we wouldn't have the purple, it would be dangerous. Thanks God, we have it. Okay, yeah. So
I'm just trying to contextualize a little bit, because Trump wants a weaker dollar, obviously, but he's fighting foreign entities, meaning he's fighting a trend that he might not be able to stop, meaning the Dixie will go higher, probably, based on what you mentioned. Bond prices will keep crashing based on the monetization, because I think there's still 700 billion, at least the Chinese still own 700 billion worth of US treasuries that will probably slowly sell into the market.
Yeah.
So he'll need to find $700 billion worth of buying or create $700 billion out of thin air to buy it. Is that a fair assumption? Does that make sense, what I'm saying? I'm trying to follow you. It's intellectually, I'm trying to keep up.
Yes, I mean, absolutely, yeah.
Okay.
Basically, the Fed, at least the Fed, which is still selling into the market, should stop to sell and maybe by itself. That would actually reduce the amplitude of the problem by a lot if the Fed would stop quantitative tightening. The Fed did slow down quantitative tightening, but it did not stop it yet. Okay. So if the Fed would start to buy, yes, of course, it would give a comfort to the market. And that's important for us. All our our four lines would turn upwards, but all four of them. So I just don't want, as a silver and gold investor and as an SPX investor, I don't want to lose against treasuries. If I lose too long against treasuries, I did make a mistake, okay? If the treasury, let's say the 10-year goes back from 109 to 120, and the silver price reaches my next physical target of 43.65 as in relation to the spot dollar, gold target 2.843 as in relation to the spot dollar, I'm fine. So I'm not, I'm not getting richer by a bond crash, okay? Important for us is that as investors in precious metals, and if I talk to me also in technology shares, and a lot of them, that we don't lose against the real dollar. The real dollar is the Treasury. So, and I'm pretty positive that on the next step we won't. We will still have to see what's happening once the mistake which investors made after the Trump election will be fully corrected. We have to watch, okay?
And it feels like I've said that before, it feels like we're a bit in limbo, especially as gold investors. Like we might have to wait till mid or end of January until the new president is in the White House and see some first policies being pushed to see what really happens. That's what I'm seeing on the gold price. I'm curious. But I'm getting off topic. I want to quickly mention one thing before I forget about it, because I didn't write it down, obviously. But bond market. Bond yields eventually, meaning bond prices crashing means bond yields are going up. Yes. At some point, there will probably be, let's call it a breaking point or the break-even point where bond yields become too interesting and too high for investors to ignore, and they dump gold.
Sorry, it's 100. It's the nominal. Bonds are being paid back at the nominal.
Yeah,
so
but
it's 100.
I use like the 10-year. Let's assume the 10-year goes to 7%, which is 2% higher than we've ever been, right? At what point do the investors say, screw gold, I'm buying 10-year bonds because I'm getting 7% here? Does that make sense what I'm asking? Like,
it's absolutely making sense.
There is a competition between gold and bond yields at some point. Right now it's being ignored because gold has been going up, while bond yields have been going down, up as well, but bond prices crashing, sorry. So where is that equilibrium where the investor says, okay, screw gold, I'm buying bonds because I'm getting way better yield here?
Under 100. Because the bonds are not only comparable to gold, but at a certain date, they're repayable. And if you can buy a treasury for 95 and got a contract with the secretary of the treasury that you get back 100 on the capital, then it's starting to be interesting. That means, yes, we are at 109, around 108, 109 on the 10-year.
Can you just translate that into yields, what that looks like?
No, I don't want to translate into yields, because yields won't explain you anything. You have to understand a bond is being paid back at 100. So the bonds did actually decrease, but they did decrease from levels which are still over 100, okay? Once you clutch on the 100, you will have a sure profit. I mean, Kai, if you can buy a 10-year at 95 and you get a sure, let's say 4% interest coupon and 5% more on the capital payback, then it's getting interesting. So that I just wanted to say you, attention, bonds, once the price is under 100, get a second character. And then they are interesting, yes.
Gotcha. Okay. Yeah. It's quite complicated. Like I'm trying to follow you as well, but it makes a lot of sense. Like which is good. But let's focus on gold and silver a bit more. The recent moves we've had, dollar strength, bond yields rising as sort of countermeasures to gold. It's been pulling it down a little bit. It seems like we're in recovery mode. We're trying to catch up again. Explain the last 2 weeks to us. Like what has gold done? What has silver done?
All three. Look, gold and silver have just been faster than the SPX 500, but the SPX 500 did test the 5,800 again also. So coming from 60, 30. So it's just a question of speed. I'm always talking about liquidity. Of course, I do not have several asset classes because they're all the same, but we have really methods to insulate phenomena, which is coming from the x-axis, which is just the dollar, okay? And that one, I just said to everybody, oh yeah, gold will be bearish and stock will be bullish. I said, wait 2 days, okay? Because liquidity is touching everybody. So it went, okay? And I think we're gonna recover a little bit over the levels where it start to correct. The problem yet, I'm talking gold, is that the physical bullet shot, which gave us this upward move against the spot dollar and most currencies, but not against assets, see here, should be ending at 2.843. So before that correction was starting, we have been pretty near, You know, like
$80 off or so,
yeah, 60 feet, exactly. Okay. While silver has room to move, the same physical shot, according to my calculation, is ending at $43.65, and we have barely reached 35 before. So that's what it's meaning. The problem now is that what I'm telling you here is pure physics. It's without the maths. We have maths also, but it's pure physics. What doesn't make it easier for any of us is, again on this chart, is that if we talk real trends, what is a real trend? A real trend is an upward move or a boom in precious metals. A boom in precious metals would be defined that they are better than normal stocks. Are they? No. A boom in tech stocks would be defined that they're better than precious metals. Are they? No. They're all the same. So we have no cycle. I'm sorry to say that. We have no cycle. This is phenomena that silver and gold and the SPX do the same for 10.5 months of a year. But they did. So that's not a real cycle. So cycle-wise, we don't get a correlation help. I'm happy I have all of them, okay? But it doesn't matter. I mean, if you would have only silver this year or just a full portfolio, you know, doesn't matter. So cycle-wise, we have no information. But that explains you why mining stocks are undervalued as compared to precious metals, because we have no precious metals boom. Okay? So, yes, yet to be seen. The cross ratio, SPX to gold, is jumping all the time, but not leaving any range. So I don't want to give you a prediction on something which is not in the data. Important is that everybody of you now has visualized that gold did nothing against stocks, stocks did nothing against gold, and gold and stocks did nothing against silver. The good news now comes for silver. We got a correction recently, right? What does silver not do? It didn't correct in percent more than gold. Hey, in a deflationary shock, silver didn't correct more than gold.
It's holding up better.
Strange. That means that with silver, we have a surprise additional factor coming more and more into the price. As we spoke last time on a digital line, and that's nuclear energy. Because nuclear energy powers heavy power plants. The demand for steam turbine-driven generators is increasing rapidly. There's been old US power plants, nuclear I'm talking, being basically rented by Google and co. just to produce enough electricity for artificial intelligence. And very important, what we see on price charts on any of them is marginal prices. It's the price of the next entity. And this demand for silver is a surprise. What really moves markets is surprises. We knew that photoelectrical collectors need silver, but this kind of atomic boom comes as a surprise. And it's going to need a lot of silver, and that silver is not there.
We're already in deficit.
Yes.
So.
And now, but it comes. You consume silver for a normal industrial process. And let's assume you're price sensitive, right? The speculator is going to buy silver because it goes up. Kai would play in here the role of somebody who has to source silver for an industrial process. So he's actually going to buy when the price goes down because you want to have it and cheaper. But somebody builds a nuclear power plant. How much is the silver? Yet several $1 million in percent of the cost of the power plant. It is so unimportant that he would even buy it while the price is rising. So here is your buyer. Here is the buyer who can break price ranges because it's a physical buyer who doesn't care to buy at a higher price because whatever is the price, is almost nothing compared to the price of a power plant. Okay? Here you got him. The non-price sensitive saucer. And we see them in the silver chart already. If things come together, can break out first to the 43, thereafter much higher. But we have to get it in parallel with at least a non-rising dollar. When we have monetary phenomena which are completely against precious metals, we can't reach those levels. Even now, all correlations which are coming from the Forex market are extremely bearish. They were even more bearish. And gold and silver did make it to those levels. Against this wind, imagine if the wind would come from the back, it would be a totally different story. I just want to tell you. That means monetary-wise, if somebody tells me there is investors in gold and silver today because of monetary phenomena, I tell him, guys, you never saw correlations. The correlations have been horrible the last years. Yeah, silver and gold did make the prices that we actually have against monetary phenomena, not sex to them. In case that extremely negative surrounding would change, it's completely other levels. But I cannot tell you if it will change, because what you see here between the x-axis and the purple can go anywhere. This can be the end of a financial system, to honestly tell you. In case, for example, the case of the, let's say, interesting Treasury would not be bought. Imagine it falls under 100 and nobody buys it. But that's the end of it, okay? Then you get the BRICS currency world. But there you will see it, not on the US dollar, you see it there. If the 20 and the 10-year go under 100 and nobody buys them and they go to 95 and 94, then the prophecy would have been fulfilled. I just want to sensibilize you where you see it. Because it's not going to be a euro US dollar which goes up. You're going to see there. Okay?
So we're at the Deutsche Goldmesse. I have to ask you, and you're probably...
I gave you prices.
I know. I'm not going to ask for it. We're not going to ask, because we got mining stocks here. I'm going to ask you, when do we see the breakout? What do we need to see? What kind of boxes do we need to take before mining stocks start to break out?
Now, first of all, you have to see preference. As we spoke, and that's why I had only this chart with me today. There's no preference today, but the good news is NVIDIA and co do not outperform silver either. Okay, this is flat. But you have to see here some preference. So I'm an investor, I'm building portfolios. There's several $billion following my portfolios. If I now say to somebody, look, based on the fact of this year, we go heavy mining stocks, you say, what you're talking about, guy? I mean, the stocks have performed same like the metals. There's no indication for massively going into mining stocks. Neither there is an indication for not doing so. But there is no fact on the table. So yes, what we would need is that, let's call it like that silver should outperform the S&P. I never saw a positive field for mining stocks where silver didn't outperform the S&P, but it doesn't. But the opposite is not true either.
It's not underperforming either. So
yes.
We're in limbo.
We're in limbo.
Fantastic. Christian, let's use the
I don't
last
want to
minute.
lie, I don't want to just, I'm not a liar. Everything I said together with you was happening later. You remember everything.
Hey, you could have said we're going down.
Since years. Okay? If I say I don't know, then I don't know. Because it's not in the data.
No, I appreciate that. You could have said it was going down, and you didn't, so that was great. That's we got to leave on somewhat of a positive note.
Okay.
We do have 1 minute for a question. We do have a question from the audience.
What is the relationship between reality and illusion?
Well, you ask me. There is a lot of relationship between reality and illusion, because if an illusion becomes majority, then it's gonna become reality.
I ask you that. That's because I just had a conversation with a company, and at the moment, the cryptocurrency, especially Bitcoin, is so high.
I like it. I have a lot of them.
Theoretically, we trust precious metal. But why the illusion succeed? But the reality at the moment are lost.
On this very, very nice exposition, which we have, we had plenty of companies here which do a great job in mining precious metals. There is no halving. They try to mine as much as possible. In Bitcoin is a halving. So that means the production gets less and less and less. And that's the answer. The answer is the supply limit that Bitcoin has and that gold and silver do not have. And that supply limit, sorry, sir, is not an illusion, it's a fact.
We can talk with Keith Neumeyer about that tomorrow.
But if you can convince Neumeyer not to mine any silver, that could be interesting.
No, fantastic. Christian.
For the spot price, okay?
Christian.
Not for his store.
Good point.
Okay.
Where can we follow your work? How can we get a hold of you?
No, look, we are doing for big portfolio guys. I mean, we're working for family offices, okay? Including myself. So the best thing is you call me more often. We make an interview.
Well, we're going to do a webinar in December.
And they take your webpage.
Yeah.
If you don't...
I'll take commissions.
You take commissions from me. I want to make you prominent, right?
We're working on that too.
Okay, we do it. No, really, no. The best is to make more interviews. Yeah. I do not have an own webpage. I do appear on several web pages, including with articles on Goldseiten, which is a competitor of yours. Not really, okay?
Not really, no.
But what we do is really the complexity as it is. I don't want to simplify because I don't want to make things wrong. No, I never simplify just for the sake of simplifying. That means I'm not the guy for the small investor who wants to have a 5-minute tip what to buy. This is why I apologize for not having that kind of platform.
Fantastic. Christian, we're out of time.
Yep.
Thank you so much.
Thank you.